All right, hey everyone. It is 3:45 on Tuesday afternoon, the first trading day of the week, and as you can see, I've got March corn put up here. We're going to spend quite a bit of time here going through the corn chart because I think it's on the precipice of a really big move either way. And here's how we can get there, right? Because how convenient is that to say, oh yeah, it might go up, it might go down, and it could go either way. Well, here's our balance sheet, and this is the balance sheet that the USDA gave us last Thursday. Now, the corn market has gone straight up about 40 cents since this report came out, okay? And let's talk about the reasons why. First of all, it decreased production by 200 million bushels, and it did that by giving us the largest acreage cut in history. And then it also decreased demand by a little bit, and that decreased the carryout by a net 15 million bushels. So if the carryout only went down that much, then why did we skyrocket higher? Well, the reason is because it leaves us no room for error to the downside, because the USDA has now trimmed the crop and demand so much that if demand were to sneak back in here and this demand number is actually lower, then the loss of supply can't be withstood and this carryout gets too tight. So this is where we currently are, and this is where we think we're going if we plant a normal set of acreage. So ultimately, we think we go lower, but because the USDA lost so many bushels from its prior reports, we can't withstand any demand shortages, so we got to go higher. Now, what demand shortages could there be? Well, the USDA's taken out a lot of feed and residual, and has taken out a lot of exports. Now, there are a lot of analysts out there that think that they're as much as 300 million low on feed and residual, and there's some analysts that think that exports will come back in. So obviously, if let's say you add 500 million bushels to this, now you're at 742 million of a carryout, and the market doesn't want that to happen because that's just too tight. So the market's trying to figure out and price in where it needs to be to bridge from here to here, okay? Because again, if we do get into a weather situation and we don't plant acreage or whatever, then it can't let it get tighter. So the market's got a really heavy job to do here for the next several months. So that's why you see this explosive price action up to the upside. Now, this definitely was not necessarily what we were expecting, because we're looking forward and looking at the numbers and looking at where we're trading, which was when the report came out way down here, and we thought, well, that should go ahead and accelerate lower. But as of today, there's nothing really strong enough to change our mind. And the reason is that this is still contained within parallel lines. Now, and we're coming into this 692 inflection point, which is what we've talked about for several weeks as being our critical resistance point. And I want to show you that on some longer term charts here in just a second. But you know, anytime we're dealing with a situation like this, we don't want to lose sight of the longer term picture, which we think is much more ample stocks, which would result in lower prices. So at some point, I would expect selling to emerge in this market. But if we break this 392 and we come up out of this corrective price channel, then it might indicate that the market's going to go take it higher because it needs to ration more demand. And so if it does get into that mode, then we need to act very quickly and get very long this market, because you just don't know what can happen. Now, all of you that have followed me a long time know that I love the cloud. And the cloud is simple for a lot of reasons. And it's because if you're above it, you're bullish. And if you're below it, you're bearish, okay? And if you just trade like that long term, you're going to make money over time. Now, you can see today we exploded out the bottom of it. When the report came out, we were trading down here, well below it. So we traded up, we fell back through it when we were accelerating lower. The market got a big surprise, and it's now catapulted it right back to the top. So now that's bullish. This is bearish. So it's right in the midpoint and the sweet spot of something that could be more spectacular. Now, if we back up and go even further time frame, this is what I want to talk about. because a few weeks ago when we were trading down here, what we talked about is how we broke out of the bottom of the weekly cloud and we wanted to be short anywhere below this. Well, now we're threatening to break up out of the top of this cloud. And we've done this a long time, and we've studied these cloud breakouts extensively. And I will tell you that on this weekly continuation chart, if you go all the way back to the beginning of our charts, which is back in the 70s, and you plot and you trade each one of these and you back test it, a upward breakout of the weekly continuation cloud is something that you cannot ignore, because the velocity with which it accelerates is too much. Now, it doesn't always work, and in fact, it works less than half the time, okay? So I don't want to get anyone too bulled up just because of this, because it does have about a 60-65% fail rate, okay? You can see one right here where it broke up out of the top of the cloud and then it failed. But even this move, 631, it peaked out at 725. That was 90 cents, right? This move here, 650, it peaked out at 826. That's about average. That's a $2 move. That's about an average move when it breaks out the top of one of these clouds, of the weekly clouds. So here, at the beginning of 2020, you're at 390. We went all the way on up to 775. So the velocity with which we tend to come up out of the weekly cloud is so great that we don't want to ignore it. It's not quite as powerful on the downside because we tend to just consolidate sideways when we break out. But to the upside, it's different. And the reason it's different is because it tends to coincide with rationing events. And in this situation where the USDA says, hey, we've lost a lot of bushels, and the number of bushels they lost overall was about 1 billion less than what the market thought that was available. So when the USDA loses bushels, the only way that it can ensure adequate supply to its new crop supply, a resupply, right? You got to bridge from old to new. The only way it can do that is by an explosive move higher to new, to ration demand. What does it have to ration? Well, it has to make sure that exports don't pick back up. It has to probably go kill ethanol, and that's a violent event, and it's impossible to predict how high it'll go. Which is why the average move, if you chart this breakout back to the early 70s, the average move is $2.50 a bushel. It's an insane propulsion that we end up with, and something that we don't want to ignore. And I want to bring that to your attention because from Thursday to today, we're right at the top of this cloud. And if we break up on a closing basis up out of it, then we don't have a choice. We have to own this market. Because we don't want to let it get too far away. That's a critical risk reward, right? You buy the top of it, you sell the bottom of it, and you've got basically a 40-cent risk versus a $2.50 potential upside. Now you only have a 40% chance that works, but that's still well worth it. You can and I think you all are with me on that it's worth. It's worth being defensive to the upside if that happens. Now, if we reverse right away, because remember, back on the daily stuff, we're not quite strong enough to call it a win yet. But if we reverse from here and break down the backside, okay, our old analysis is still holding, and off we go. Now, for those of you listening that are kind of confused, you're saying, hey, you're talking out of both sides of your mouth. You're saying we're short corn and we need to, we're tight supply and we need to ration, but we're also coming into a plentiful crop. Well, that's not being inconsistent, because that's exactly what these numbers tell us. That tells us that we're tight. The analysts are telling us that maybe this number's too low, so we may be actually, in fact, tighter than this. But even if we start to grow a bigger crop, we still have plenty. So let's say that the analysts are right and that this is only 700 million, okay? Let's drop that to 700 million and see what happens. We're at a 1.6 billion bushel carryout next year, assuming 92 million acres in normal growing weather. So long term, we can withstand it, but short term, we can't. So if this number starts to creep up, this number has come down too far, and if this one creeps up, then we're too tight. We have to go bridge that and probably make this number, closer to a billion instead of 700 million. So it's going to go kill some demand somewhere, is what I think is going to happen, and we're going to rely on these daily and weekly clouds in order to help us out. And that a weekly breakout of this cloud is going to coincide with a daily breakout of this hedge line of this corrective price channel off of this low, and it's going to coincide with a break of 693. So higher prices will probably beget higher prices, and if that becomes and if that comes to reality, then we're going to want to step in and buy it, even though it gets higher, even though it's higher values than where we are today because of the velocity of where we go. Where might that move go if it were to materialize? Well, in general, you go 38.2% past the old highs is your first target, and where that takes us to is to 741. This is on daily chart level, okay? So you're looking at these points. But if you go to the weeklies, now I don't want to get everyone too bulled up here. I'm going to show it to you just because I don't want to be disingenuous. But if you do break up out of here and you have a normal move, you have a 38.2% extension off of this wave of decay, you're targeting 930 off of this move. And what is 250 plus 687? You got it. It's 930. It's exactly where that count calls to, which is why I think we need to be very aware of what's happening with this move this week. Now, we still have 3 more days of trading yet, right? We got Wednesday, Thursday, Friday to get through, and this does not confirm at all until it closes up outside of this cloud. And if it does that, then we need to really rethink where we're at. But I hope that gives you a little bit of an explanation, at least some sort of clarity as to why we can be bearish, but long-term and bullish short-term based off of these numbers. But, if the USDA raised yield, lost acres, and shrunk supply, if it's off on its demand numbers too, right? I mean, if it's off on both and squeezes that balance sheet and stocks to use too tight, then we have no choice but to go kill demand. And the market is probably justified in saying, hey, USDA, you were off 1 billion bushels of supply. Why wouldn't we think you'd be 400 or 500 million off on demand? Right? I mean, that makes a lot of sense. If they're off on one, why not the other? So you see that type of propulsion that we end up with to the upside on corn. Now, beans are a little bit different. I'm not going to get in depth into beans here. Obviously, they broke up to new highs. I think it's all in corn's camp here. If the bean demand does come back, obviously we're too tight here. We'll have to step in and buy it. But it's going to turn into an acreage battle. And we may end up having to step in and reown both of these markets pretty darn quick if those signals were to continue. So for all of you that are new to this, markets change, and you have to go with the most recent signal. And so this signal right here is bearish as hell. I mean, it is breaking out the cloud. It's in a wave 2. It bounced off the 61.8. That is as bearish as it gets. So you have to step in and sell it. And now if it reverses and pops back out and gives you a buy signal, it forces you to step in and buy it. That's just fine. Over time, it pays to take those signals, and it pays to keep aware of what these bigger time frames and bigger trends are doing. Now, one other way to manage this situation, okay, and I just want to be clear with people on this too. You can just pick a point and say, hey, anywhere above 680, all this resistance and shelf right in here, anywhere above that, I want to have reownership on. Or you can say anywhere below 692, I want to be short, or I want to reown above that. Or anywhere up above this high here, you could, this is justified, is to say, hey, above 711, I want to be long, below it, I'm happy. Or above 635, I want to be neutral, and I don't want to sell it again until it gets below there. You can pick a horizontal line that makes sense to you and works within your farm's numbers and budgets. What you don't want to do is just continuously change your targets. Pick one and stick with it. And that's exactly what we do. The bottom side of these clouds, we're going to sell them. The upside of these clouds, we're going to buy them. But we're going to make them earn it first by coming up out of these types of base channels and breaking prior highs before we do it. So corn's really, really close, and we'll keep everybody apprised, but that's exactly what it is that we're looking for. I hope that's helpful. Remember, there's risk trading futures and options. We'll be back out tomorrow with soybean and wheat charts. But I think corn's most important for you to look at, because I think as corn goes, everything else is going to roll as well. Hope you guys have a great night. We'll talk to you later. Get some sleep and enjoy the Sunflower Showdown with KU and K-State tonight. I know our office will be watching it close. Talk to you later. Bye-bye.